On February 12, 2021, Opendoor reached over a $20 billion valuation as its share price hit almost $35. But fast forward to just a couple months ago, the stock bottomed out at 50 cents a share, following a calamitous multi-year decline. For shareholders like myself who bought the stock early on, and actually bought it pre-SPAC back when the ticker was still IPOB, this has been a pretty disappointing journey, watching what was once a category-leading startup turn into a laughingstock of a failure. But something incredible has happened over the past month. An unexpected rally around Opendoor has propelled the stock back up to the $3 to $5 range, buoyed by retail investor hype, macro tailwinds, and a meme stock narrative that it could rebound 10, 50, or even 100x, as did Carvana stock. At the end of the video, I'll share what I actually did with my stock, but in light of everything going on, I wanted to cover a brief history of how Opendoor came to be and how it ended up here, at a crossroads of either becoming a turnaround success story or another dead tech company. Let's start with why Opendoor exists in the first place and what they do. It was founded in 2014 by Eric Wu, a repeat real estate entrepreneur, Keith Raboy, a well-known Silicon Valley venture capitalist and PayPal Mafia member, JD Ross, VP of Product at Adapar, and Ian Wong, an inference scientist from Square. They set out to solve a specific pain point, that buying and selling homes is overcomplicated, inefficient, and just a giant pain in the ass. Just like many other incredible companies reinventing different industries, like Uber with transportation, Airbnb with travel, and Carvana with car buying, Opendoor set out to do the same thing to residential real estate. The premise of the product was simple. Any homeowner can go to Opendoor, enter their address, and get an instant cash offer for their home. Instead of the typical laborious and expensive process of getting an agent, repairing the home, staging the home, doing showings, and then wading through waves of paperwork and negotiations, sellers can just sell directly to Opendoor and condense the process to days instead of months. In exchange for the convenience, expediency, and certainty for the seller, homeowners would typically sell for a slightly below market offer, and Opendoor would take a fee. Then Opendoor would make some light repairs and try to flip the home as fast as possible for a profit. Now, there are two narrative extremes of how you could view this business model, which is also known as iBuying. The optimistic view is that Opendoor is a tech-enabled real estate platform. It uses machine learning and sophisticated algorithms to right-price their bids on houses in real time and flip homes at scale. And there's a platform play here to layer on verticalized services like financing, title and escrow, etc. It's with this narrative that Opendoor IPO'd with a favorable tech company multiple and saw its stock price soar. At first, the company seemed to be firing on all cylinders. It went public in late 2020 through Chamath Palihapitiya's SPAC on the pitch that Opendoor would become the Amazon of real estate. The whole SPAC vehicle and even Chamath himself are both very controversial. Some might say that going public via SPAC allows company to not adhere to as strict of accounting and disclosure requirements as would more conventional avenues. Chamath also takes a lot of heat for allegedly taking advantage of the ZIRP IPO window to prop up a company that maybe wasn't ready for the public markets yet, thereby allowing insiders to cash out at the expense of retail investors. But let's set that aside for now. Initially, things seemed rosy. Opendoor scaled up its iBuying program nationally and revenues rose. Through 2020 and 2021, again during peak ZIRP, the era of zero interest rate phenomenon, housing prices just kept going up. So Opendoor's model looked like it was working, but so did everyone else's. So was the success due to Opendoor's secret sauce giving it an edge, or was it just due to a booming overall market? Whether it was commercial real estate, multifamily, residential, everyone seemed to be making money hand over fist because you could underwrite deals with perpetual rent growth and low interest rates. But as interest rates spiked in 2022 and housing activity cooled, Opendoor was in trouble. And by the time they reacted, it was already too late. Their newer inventory, acquired at prices underwritten for ZIRP, were now underwater as home values fell. But they still had to move inventory. For their business model to work, they can't have a portfolio of inactive capital. Flippers need to flip houses on as short of a timeline as possible. Holding on to vacant houses and just waiting for an uncertain recovery will just spiral their losses and kill future growth because that means they can't be reinvesting that money in acquiring new inventory at better prices. So they took the L, they sold houses at a loss, and slowed down their pace of acquisition. It was during this period that CEO Eric Wu stepped down and the board member turned CFO, Carrie Wheeler, stepped into the CEO role to salvage what she could. Opendoor wasn't alone in its struggle though. The whole real estate industry suffered, but for the iBuying space specifically, it was an existential wake-up call. Opendoor's top competitors in the space, Zillow and Redfin, also were burned by large losses, and they decided to shut down their iBuying businesses for good. This was maybe good and bad news for Opendoor. Good in that their competition was leaving, but bad in that they were potentially trying to stubbornly hold on to a business model that just didn't work. Nonetheless, they made major corrections under Kerry Wheeler to survive by reducing operational expenses, dramatically tightening their home buying criteria, and starting to diversify their product offerings for the sake of survival. So now the narrative shifted to the other extreme. If Zillow and Redfin couldn't make it work, then why would Opendoor fare any differently? Were they just stubbornly clutching to a broken business model and delaying the inevitable bankruptcy? Perception now soured, and you started seeing people call Opendoor a failed home flipping business, just masquerading as some sort of tech company. And with that, shareholders fled the stock, the share price dropped under $1 this year, and they faced the threat of being delisted from the NASDAQ. Now this is where recent events get interesting. As of a few months ago, Opendoor was just quietly languishing. Nobody really paid it any attention, except for Datadoor, a small community of longtime, die-hard Opendoor shareholders. I've been a member of the Datadoor Discord since the early days, so I've had a passive but front row seat in seeing the retail analysis and sentiment evolve over the years. And in my opinion, they deserve the most credit in this retail rally. We're now seeing professional investment influencers like Eric Jackson and Anthony Pompliano commandeer the retail microphone in a sense, and they've become the faces of the rally. But I think real Opendoor retail OGs know the names Tyler Auckland and Sebastian Suro, the creators of Datadoor. What they've done for Opendoor, I think, is still super underrated. Around 2022, Tyler was a med student at Stanford, trading stocks on the side, and Sebastian was a software engineer at Shopify. Both of them independently took an interest in Opendoor, and I believe Tyler met Sebastian via Twitter as he was posting his analysis and commentary on Opendoor's iBuying data. They decided to team up to build a data analytics product that could forecast how Opendoor was doing ahead of their earnings calls. This data would be valuable for investors trying to get an edge in trading the stock, and they had customers ranging from professional institutions as well as a bunch of retail folks. Here's how Datadoor worked in a nutshell. Real estate transaction data in the US is publicly available through MLS feeds and county records, so every time Opendoor buys and sells a home, that data is out there. Datadoor does the work of scraping, standardizing, and analyzing that data to measure things like sales, gross margins, holding times, and purchase prices, and they display it in a nifty dashboard on their website. The projections have been pretty spot on over the last few years. But perhaps just as important, if not more important than their actual analytics product, was their Discord server. For much of 2022 through 2025, Datadoor has served as a hub for Opendoor retail shareholders like myself. Every good movement needs a rallying spot. For some meme stocks, that might be the Wall Street Bets subreddit, but for Opendoor, it was Datadoor's Discord server. The key events leading to the recent rally that I can pick out are as follows. And please do correct me if you see it differently or if I'm missing something. But in May, a longtime Datadoor member and shareholder named Greg wrote up an essay detailing his bull case for Opendoor. He shared it in the Discord server and was actually a bit hesitant to post it publicly online. And by the way, anyone can see the receipts for themselves right now by joining the Datadoor Discord server. I'll link it in the video description. It's pretty cool that you can actually go back and read the Datadoor conversations and see the moment Greg decided to post his essay to Wall Street Bets. But anyways, in May, after shopping it around in the Discord, Greg posts his essay to Wall Street Bets. And that post went viral. It had all the ingredients of a banger post. It had a catchy title, Opendoor is the next Carvana. It showed that he had skin in the game to the tune of a $155,000 investment. It provided the industry context and was self-aware. Yes, this is a broken and beaten down stock, down 98%, but here's the path back to life. It had a stick it to the big guy / stick it to the shorts angle that retail loves. He noted that hedge funds were shorting Opendoor so that it would get kicked out of the Russell 2000, and that general short interest was pretty high. It also explained Opendoor's business model in plain English with explain like I'm 5 examples. It had charts and numbers that most people probably don't read, but it makes it seem informed. It also laid out the path to profitability. Opendoor has shrunk its headcount, it sold off most of the houses they had overpaid for, they've refinanced debt, they've added partnership with agents as a new revenue stream, and if the housing market as a whole recovers, then all their metrics are going to improve. And most importantly, it was written in the right tone of a little bit of self-denigration and humor. This was a coming out party that brought Opendoor to the attention of the masses. Among those was Eric Jackson, a self-proclaimed failed hedge fund manager and prescient stock picker of Carvana before that stock made its crazy recovery. Now, how do you describe Eric? This guy's hilarious, he's smart, he's a bit of a troll for sure, and regardless of what you think of him though, he's a big factor in carrying the baton forward and amplifying the Opendoor message. The guy bought call options and shares of Opendoor and has since been tweeting nonstop memes, hot takes, and rallying messages about Opendoor. So as Opendoor's awareness spreads from Datadoor to Wall Street Bets to X and social media, the stock price starts to rise. More and more notable people start to join in on the conversation. Among these are many current and ex-Opendoor employees. Shrisha, the CTO, chimes in with messages of acknowledgement. The co-founders, JD, Ian, and Keith, chime in with messages of shared frustration with where the company has gone and ideas on how to move forward. The consensus view emerges that Opendoor has been mismanaged into the ground and has lost its prior vision and leadership. The fall guy, or fall woman in this case, becomes Carrie Wheeler. Both Eric Jackson, Keith Raboy, and others start to call for her immediate resignation. Keith makes some cryptic tweets about how he's making certain things happen behind the scenes. The stock price fluctuates between $2 and $5. Then, as of this past week, Carrie Wheeler announces her resignation. Shrisha gets appointed president and interim leader of the company, and a CEO search commences. Interestingly, in Carrie's post, she mentions that she actually approached the board mid-year, so I guess call it a couple months ago. So I don't know, maybe there's more happening behind the scenes already. But anyways, that's where we're at now. It's been a whirlwind of events over the past month, and I'll say that even as someone who's followed the company for a long time, it's very hard for me to guess what's going to happen next. But I guess here's my take. First of all, I want to call out that there's a lot of noise and not a lot of signal right now muddling up the social media discourse around Opendoor. And I think separating fact from fiction and some of these fantastical takes from informed takes is critical. Part of this has to do with the mixed intentions of mercenary versus missionary type actors that have flooded the shareholder base. Obviously, everyone is in it here to make money. I'm not saying otherwise, but there are some who believe this is a long-term hold for a long-term turnaround. There are others who are trying to swing trade the sequence of events and playing musical chairs to not be the backholders at the end of it all when the music stops and the rally ends. And there are others who might say they're one thing but act like the other. And it's not always clear who's who. I kind of roll my eyes a little bit when I see people saying that this stock is going to 100x in the next few months, or when they start slapping buzzwords everywhere like AI transformation and stuff like that. I think what does matter is first, who gets the CEO nod? Maybe the co-founders could play in an active role again. Maybe they could hire some other ex-tech founder or notable operator. Two, the vision and how it's communicated externally needs to be ambitious and clear. Ian Wong actually already outlined one version of that, which is to capture 25% of US residential real estate transactions. And three, we need to see the overall real estate sector start to rebound. The aforementioned improvements combined with a favorable market can really make the stock take off. I'll also make a small side prediction that if Opendoor pulls off its recovery and the stock hits, say, the $10 to $20 per share mark, I bet Chamath breaks his silence and takes a victory lap. The guy has been criticized relentlessly for his SPACs, and I bet he's just waiting for one of these SPACs to do well enough so that he can argue back. I mean, SoFi is already doing well, but I think he needs at least one other big win to redeem himself in the eyes of retail. As for me, I actually cut my losses earlier this year and sold the stock in the $1 to $2 range. I know, I kind of regret it. I didn't have diamond hands. I held it back for years and kind of gave up hope. I love the company vision and I wanted to believe, but you can imagine year after year seeing the company not executing in any way that will lead to a strong recovery. I just lost hope. I have bought back a small position though, and I'll be closely following along the ride. As always, this is not financial advice, and I would caution against believing the 100-bagger narrative because anything could happen and you should do your own research. So that's all I have to say on the topic for now. I hope the video shed some light on this whole journey, and I hope that the company does well, because big stock gains aside, I think the real estate industry is a better place for consumers if Opendoor succeeds. And again, shout out Tyler, shout out Sebastian, and shout out Datadoor for being the rock in this whole movement. Thanks for watching.